Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He's speaking to us from Vancouver. Welcome back to the show, Bob.
Yeah, hi, Jim. Here we are. It's Friday, and we're together, and we've got some listeners out there.
Bob loves answering listener questions. We have one from our friend Caden in Ontario, and he writes us, "Hi, Jim. I hope you and Bob are doing well. I am. How about you, Bob?"
Yeah, I'm fine.
The question for Bob is, since the Great Recession of 2008-2009, it seems the answer to keeping the world economies afloat has been endless QE and low interest rates. It also seems that this is the only solution the Fed has in its toolbox for solving economic issues. What does Bob believe is the primary cause for deflationary cycles, and does he believe we will see continued increases in QE when the next recession takes place?
Yeah, that's a good long one, Caden. Yeah. Yeah, we have been in a decade of inflation in financial assets. And it followed a decade of pretty good commodity prices. The actual high was 2011. But you got to get some nuances in here. It's not Fed easing, which is the only thing they know what to do, that causes things to happen. It's the public that chooses what's going to happen. And in one decade, they will choose to speculate in commodities and wages, CPI, all that sort of stuff, like going up into 1920. And then that reaches a huge climax and crashes. So here's the irony. In the 1920s, well, I'll give you an idea here. In the global boom in commodities in 1920, the U.S. rate of inflation got up to 24%. Back in 1980, it was 14%. And then it crashed down to minus 16%. So then the Fed was stunned, and they then were easy through the 1920s, not understanding that when you have had a decade of rampant speculation in commodities, you follow by a decade of rampant speculation in financial assets, stocks and bond prices, namely. So this is where we are now. We have been in a decade of until recent, relatively quiet commodity prices. And this then gets the Fed worried about deflation. I've gathered a few headlines on this one over the last decade where the Fed is concerned that there's not enough inflation. They have to get it up to 2%, that sort of stuff. So here they are. You're in, again, a decade of inflation in financial assets, stocks and bonds, and the Fed is providing fuel for the fire, not understanding fully the problems of when a great financial bubble concludes and crashes. And this is what's ahead of us. So gets a chance to do my little lecture on the two different kinds of inflation. One is in tangible assets, when stocks and bonds, particularly bonds, don't do well at all. And then you get the public chooses. And the public chooses to speculate in financial assets and takes that to the limit, which is perhaps being accomplished. And then when you get the post-bubble contraction, prices of most everything go down. So there's the two kinds of inflation. Tangible assets, and when it's over, it sets up inflation of financial assets, and when it's over, it sets up deflation in most assets. So this is where we're looking at now. And there's a couple of lately the energies, nat gas, and crude oil, and uranium are going straight up. But some of the ones that went straight up earlier in the year, such as lumber, or even they got all excited about iron ore for a while, and those have rolled over and are dying. So, anyways, what we watch in crude oil is years ago, a seasonal on that one worked well, and that seasonal was that you could have a rally into late September, early October. Hey, what's happening now? And then the seasonal lows have been quite reliable down in January. But considering how speculative the action has been in commodities, with the boom that goes with the bubble, I think there could be some fairly severe hits to the current crop of hot commodities. Well, lumber got up to, $1,700, and now it's back down to $600, that sort of thing. So, anyways, good question.
We'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, China is undergoing a semi-economic crisis, maybe a major one, because Evergrande can't make its interest payments, and it's the second biggest real estate firm in the world, I believe. And also now they have blackouts because they can't generate enough power. I think that's probably one of the reasons why they banned cryptocurrencies, because it was such a strain on their power system. But now they don't have enough electricity. What's going on in China? And if there's a problem in China being the second largest economy in the world, is it everybody's problem?
Yeah, it's a raging world out there. And while the communist authorities are talking down bubbles, they may have exhausted themselves naturally anyways. In the case of Evergrande, yes, just became overdone, overextended, and then could no longer kind of roll over its debts, and it's been desperate. So I would say that what we saw in March was the announcement of problems in Turkey, Argentina, and South Africa, where their central banks had suddenly run out of dollar reserves. And with that, the U.S. dollar rallied up to a little over 93. But then that one was kind of parked and forgot about for a while. But then I've done a study back in 1873 with that bubble. You had problems with debt in Spain. So all the way through the year, The Economist then reported headlines about problems in debt in Spain, and then eventually riots and whatnot in August. So what then happens is that in a boom year, or this one's a crazy bubble year, when small or outlying countries suddenly discover they've got a financial problem, that burbles around for a while, and then now I always used to use the term lesser exchanges, but you consider the size of China, it's not lesser. So I use the term outlying, as outside of the financial centers of London and New York. But what has happened in the past on those things is that they eventually hit the financial center. And this is really old kind of action, because 2,000 years ago, the Roman writer Cicero wrote that if you have a financial problem in the eastern provinces, meaning at the east end of the Mediterranean, Phoenicia and places like that, that if they had a financial problem in the credit markets, it would eventually hit Rome. And this is indeed what's happening here now. The credit spreads in the U.S. were expected to narrow into around mid-year. They did, and then they've been widening, but nothing dramatic. The other thing is that we were looking for most commodities to be strong into around mid-year, and some of the key ones, grains and copper and whatnot, were. But now you've got this, as I mentioned a little while ago, terrific speculation going on in the energies. You've got straight up for crude oil, but it's too, let's just round the number out to 77, where there is considerable resistance. And you've got natural gas, and now it is now, as of this week, generating technical excesses. So this move is close to ending. And then you've also had a straight up in uranium. So I think it's the last tag in playing commodities, and we're now looking for some seasonal weaknesses following terrific technical excesses being recorded, specifically in that gas. So the any weakening of commodity prices would not be friendly to the stock markets, and it wouldn't be friendly to lower grade bonds. And I know no one knows. We've been watching the emerging market debt in our system, symbols EMB. And for the last 5-6 weeks, it's been really underperforming, say, junk or high yield. And so this is a telltale. So there's Jim, a number of telltales there that are providing a warning, but have not yet become dramatic. And this is, of course, what we're watching for.
Bob, the last time we had a big drop, that March disaster, you said transports had given adequate warning of that, and you weren't surprised by it. Are transports weakening?
Yeah, the old Dow theory is that in a bull market, the Dow industrials keep rising, and transports, used to call it the rails, keep rising. And so one confirms the other, but the one that usually departs is the transports now, we'll call them that. And they've been underperforming the Dow industrials. So the phrase I've been using is they've been working on a Dow theory sell, but it needs the industrials to actually take out a certain low where the transports have already done that. So giving a warning, but not yet a sell on that one. The other one for the stock market is the breadth of the market, which is also called the advanced declines. It's the ratio between the number of stocks that are advancing and the numbers that are declining on any given day, and then you add them all up, that sort of stuff. And the ADs have had a terrific rise, steady rise, until 5-6 weeks ago, when then the action has become choppy. So we look back on the last time the advanced declines became choppy, and that was in 2007. And so here's another one that is giving a warning, but is not actually pushing the sell button yet. But the main thing is giving a warning at a time of the year when, if there is going to be a credit crisis, they're usually discovered in the fall. And it's also discovered in the year where you've had a huge party. We've had the party, we've got fabulous successes, and now we're watching the unwinding and let's call it a transition to a potential contraction.
Individuals are embracing options trading. What does that tell us?
Oh, right. Yeah, there's Yeah, you've had newbies into the markets. I get my guess, and I haven't got numbers for it, is probably the best since about 1968 or 69. So you've got the public, the general public is in the market, and many of them are acting quite recklessly, and then they're also discovering trading techniques that enhance their leverage, so they're playing options and whatnot. So that's, and then also that headline by the Wall Street Journal said that this specific way of trading was turbocharging the stock markets, which was an interesting line. So, yeah, public is in, and they, on this kind of market, they really get in on a fabulous bubble, and then disappointment follows.
Another headline that caught your eye today, panic buying leaves 90% of UK gas pumps dry.
Oh, yeah. What a tragedy, Jim. You've got very ambitious politicians and media people and out there with the notion that carbon dioxide is evil when it's essential for life. And then in England, they had tremendous production of oil and gas from offshore, and they also, if they could get fracking onshore, they would solve their problems. But they're shutting down reliable sources of power, such as from nat gas or crude oil, and at the same time Northern Europe is doing it. And there's just not enough power for when you're in a boom and what it's going to be like when winter comes. And then also part of this is a shortage of gasoline. And you haven't had a shortage of gasoline anywhere in the civilized world since the early 1970s, when that first energy crisis arrived. So we're not going to get into that one. But anyways, I think this winter in England and Northern Europe, also North America, ordinary folks are going to be looking at the low temperatures and the extraordinary high costs of energy, and that those high costs of energy are deliberate, because with the Biden administration, their first step was to do whatever they could to shut down oil and gas production in the United States. And then, of course, in Canada, the federal government is dedicated to shutting down not just oil and gas production, but transportation of it through pipelines. So these are very strange times. And even a moderate winter, there's going to be shortages of heating energy. And if it ends up being slightly cooler than normal, then it's going to be a crisis. I look at it as the public's just going to get so fed up, going to say too much, you're out of here, and begin to reject the delusions that the authorities have now, that somehow they can shut down all of gas and oil production, and everything's going to run off of windmills and solar cells and batteries. And it's not going to happen. So, but the struggle is going to be interesting. Yeah, watch for it this winter.
Bob, thank you so much for chatting with us.
They're very good to be with you, Jim, and look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He was speaking to us from Vancouver. If you have any questions for Bob, we'll gladly answer or ask that question for you the next time we talk to him, which will be next Friday. You can send your questions to info@howestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at talkdigitalnetwork.com. HowStreet.com Radio is a production of How Street Media Incorporated.